What can the math of gains and losses mean for you and your assets in retirement? Watch this short clip of a webinar that I did to show you how critical it is not to lose what it's taken you decades to save. Enjoy.
I'm going to go over this real quick. The math of gains and losses, guys. This is why it's very, very important to limit the amount of losses that we have in retirement, because a larger percentage gain is needed to overcome a smaller loss. And so if we think about it, if we have $100,000 in the market and the market goes down 10%, we got 90,000. Well, if it goes back up 10%, we're not back to even. We're not back to 100,000. We're at 99 because now it's 10% of a smaller number, right? And so if the market goes down 30, 35, 40, which we're kind of like, hovering in on this amount right there, well, the market's going to have to go back up 67% just to get the account balance back to even. And if we're pulling money out during retirement, at the same time this is happening, that's a double hit to a portfolio, double whammy. That's a technical term if you want to go there. So the problem is volatility, as we just have been shown, is back. And so we want to make sure that we develop portfolios and plans that can be successful regardless of what the market's doing. So this is the problem that we normally see. And this goes to why we do, this is probably the best example I've seen of why we do a low volatility approach to investing. Because this average return thing that advisors love to talk about, this average is this fund average is that fund average is this over there. Averages don't tell the whole story, guys. I feel like our industry hides behind averages quite a bit. So we've got right here, you'll see two choices. You've got an 18-year average return of Vanguard, which is about a little over 6, and you've got some money manager you've probably never heard of, because there's a lot of them out there, that averaged about 5.3%. And if those were the only two things that you had to choose from, that's all you knew, pretty easy choice, right? Vanguard, very well known, low cost, all that kind of stuff, right? Great. I'm not dogging on Vanguard either, by the way. So I actually, we have a lot of their stuff because they have good funds, they have low cost stuff. So yeah, but the problem is averages don't tell the whole story. If you look at the returns from 2000 all the way to 2018 of the S&P 500, basically this is the Vanguard S&P index fund right here. You've got big negative years, 22% there, 3 straight down years, but then a big 28. Oh, negative 37, but a 26, hey, and a 32, all right, down a little bit, up a little bit, right, and 6% by the end, not bad. Then we look at the other one that averaged 5.29, and there's ups and downs, yeah, they are, they're just not that big. And when I say they're not that big, neither one of them, like the downs aren't that big, but then the ups aren't that big either. I mean, biggest year, boom, right there, 15.16%. So that's not that, it's like less than half of the 32% that was the largest year of the S&P 500. But when you start marrying the money to the math, you get a little bit better picture of what's going on. So let's say we have $1 million in each one of these. $1 million, then we apply all these growth percentages year over year. What's our balance going to be? Well, at the end of that time frame, 2.28 million. Awesome. Well, it wasn't a straight shot, right? I mean, after 2002, we're down to 620, and then we finally make it back and we get hit by 2008. So it was really a decade right here before we got and stayed at $1 million. So it was a whole decade of no growth. None. A decade. Right? Everybody's talking about 2008 and how bad that was. Well, at least it was fast. It wasn't like 3 straight years there, and it wasn't a full 10, right? And then we had, of course, now we're in the largest bull run that we've ever been, minus, what just happened. And so it was 2.28. The other one, you're probably guessing, has more. Lower average return, and it goes from $1 million to 2.58. So we got 2.28, 2.58. It's more. So how does a lower average return give you more money? Well, it has to do with the math of gains and losses, guys. But this is when you're putting money in. Most of us, if we're in retirement, we're not in that situation anymore. We're pulling money out. So what does this look like when we pull money out? Guys, the results are going to be compounded. So it's infinitely more important to be able to guard against this, because if we just leave it in the stock market, the S&P 500, right? Because it's like, hey, Wall Street says you got to risk more to make more, right? And so you're going to go from $1 million, you're going to take out 5%, just 5, right? Remember, we averaged 6 in this one. So we averaged actually higher than this in both portfolios. This one's averaging 6, taking out 5%. We go from $1 million down to $296,000. We lose over 70% of our value in a portfolio that averaged a higher return than what we took out. That's an issue because of the math of gains and losses, right? And all of that volatility. So With the other one though, that averaged 5.29, we go from a million, take out that same 50,000 every single year, go from a million to 1.1 million. Who actually was able to grow slightly during that time. And I tell people, really, your advisor really only needs to do three things for you in retirement. I mean, it's great if we can help save a couple $100,000 on taxes. That's awesome, right? But honestly, three things: maintain your principal, take income, and if possible, grow it. If those three things happen, that's a successful retirement. Take income, maintain principal, grow it. That's it. I mean, think about that. That's it. Very difficult to do with a lot of volatility. Very difficult to do when stuff like now might cause somebody's portfolio overall to be down by 30%. Very, very difficult to climb back out of that hole. So we've got to limit that volatility, guys, limit it. And so here, what we're looking at is, well, I guess the next question a lot of people have is, well, shoot, do I have portfolio one or portfolio two? How would you know, right? Well, you could pay several $100 a month on some subscriptions and get a finance degree and figure it out, or you could have us do it, because that's what we do. We have something that we call our resuscitation report, which if anybody does want us to run that, we can.
So do you have portfolio one or portfolio two? If you'd like us to run a resuscitation report for you, getting that started is as easy as just finding a spot on a calendar. It's a simple 15-minute phone conversation. Our Calendly link is in the description below. And if you want up-to-date answers for your retirement questions, make sure that you smash that subscribe button, hit the notification bell, so that way you're notified of all of the content. As we put it, we download new content every single Friday, and we always want to help people enjoy the retirement they deserve. So thank you, and look forward to seeing you on one of our next videos. Take care.